Ideanomics is a stock that's really expensive right now, but does that make it a good long-term investment? Aside from the price, that just tells me when I should jump in and buy up the stock. That doesn't tell me whether we have a good business behind the ticker symbol. I grade everything on a 0 to 99 scale to make it easy to understand. These next 5 metrics will tell me how good of a business we have in front of us, and then we add that with our intrinsic value, and I can tell you whether you should jump in or run away from the stock. Here's the growth rate along with my grade. I'd avoid companies trending at negative growth. I want to figure out how much the company is growing, and that's why we look at earnings growth over the next 7 to 10 years. Ideally, we want them to grow a lot, but if a rate above inflation is on the right side of the grade scale, that's better than nothing. But we'll see, we still got 4 more metrics to look at. Here's the PE ratio along with my grade. Hype is the difference between digging for gold alone or in a big crowd. The less hype, the better. Most people look at a PE ratio simply as a valuation metric. I look at it as a hype indicator. I like less hype, and less hype translates into a smaller PE ratio. Ideally, a PE of 15 or less is what I want. I'd settle for 25 or less, but anything more and we're dealing with a stock that's too overhyped to justify its earnings multiple. Here's the dividend yield along with my grade. Keep in mind that you can't take dividends as the only reason to buy. An asset that doesn't pay you anything is not an investment. It's just an expensive way to play hot potato. You're hoping the next person you sell it to pays more than you did. I want to get paid to own a stock, so the higher the yield, the more money you'll get. But of course, bad companies can entice you with huge dividends. Here's the return on equity along with my grade. This is one easy way to see if you're dealing with a good or bad management team. There's no point in owning a stock if it's using your money inefficiently. I look at return on equity as a way to see if they're making good use of your money or wasting it on stupid things. Ideally, the higher the rate, the more efficiently that money is being spent on growth, dividends, R&D, production, etc., etc. Here's the free cash flow along with my grade. We want a company with market dominance. Cash is king. The more you have it coming in, the more you use it to expand and grow your business. The bigger the war chest, the more dominant you are as a business. All this cash flow creates a gigantic economic moat, enabling a company to destroy competitors and attract more customers. Okay, so we have all our numbers. Now we can see what kind of investment we're dealing with. But before I get to that, consider joining my Patreon. You'll get access to every grade from every company I've analyzed. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. With all 6 metrics together, here's the final grade along with what type of investment I think of this company, and my recommendation of its long-term potential. This analysis is simple, yet an effective way to get your research started in the right direction. In the short term, bad companies can have huge gains while good companies can get cheaper. But in the long term, the difference between good and bad will become obvious. If you want more analysis videos, here's a couple of them. Invest wisely, and as always, take care of your money.